What I have for you today is an interesting case about principal purpose. And it's a UK case not dealing with the Article 29.9 OECD principal purpose, but another one. And the case you can see yourself here is Burlington Loan Management DAC. And it concerned the matter of whether interest was specifically moved from the Caymans, I believe, to Ireland to make use of the UK-Irish Treaty and their exemption from UK interest withholding tax therefrom. Now you see in the background name Davidson Kempner Capital Management LP, and these were the managers of a company called BLM, which is the appellant in this case in Ireland. And then Lehman Brothers, which went bankrupt during the financial crisis, is the debtor in this particular case, and there was a loan of 142 million pounds and some outstanding interest of 90 million pounds, which were paid. Now the interest was paid, the loan was largely paid down already when BLM acquired the loan. It was primarily the interest that was due. And the history of the loan is that it was first issued to Lehman Brothers by the SICL, Cayman Island Company, which then transferred the principal to a Cayman Island broker called Jeffries for 82.4 million, who then transferred the principal to BLM, and then the principal was referred to as a SARD loan because BLM acquired quite a number of loans in the bankrupt Lehman Brothers entity. But the case specifically dealt with primarily the transfer of the interest from SICL to BLM and whether it was only done for the principal purpose of making use of the UK-Irish Treaty and the interest withholding tax exemption. So if we have a look at what Article 12 of the UK-Irish Treaty says, it deals with interest, and now paragraph 1 says interest derived and beneficially owned by a resident of a contracting state shall be taxable only in that state. So interest derived by BLM in Ireland shall be taxed only in Ireland, and it shall not be taxed in the UK. There is no paragraph 2 dealing with withholding taxes. But then paragraph 5 comes and says the provision of this article shall not apply if it was the main purpose or one of the main purposes of any person concerned with the creation or assignment of the debt claim in respect of which the interest is paid to take advantage of this article by means of that creation or assignment. In other words, to take advantage of the exemption from paragraph 1. And HMRC basically claimed that this is what the deal was about, that SICL would have paid 20% withholding tax on interest. In the end, it transferred the principal, of which most of which was paid, primarily for the amount of the interest that was still outstanding. And instead of only getting 80%, which SICL and the Caymans would have gotten being 100% of the interest minus 20% withholding tax, BLM paid it 92% of that interest. So BLM got more because it got 100 from the Lehman Brothers estate, and the Cayman Islands got more than 80 because it ended up with 92, right? So they split the interest withholding tax exemption is basically what the HMRC argument was. A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses. Now, if we look at Article 12.5 of the UK-Irish Treaty compared to Article 29.9, then we see that there are some differences, right? I mean, paragraph 5 says the provision of the article should not apply if it was the main purpose or one of the main purposes of any person concerned. And if you look at Article 29.9, it doesn't have a subject, right? Because it's written in the passive voice. Notwithstanding the other provisions of this convention, a benefit under this convention shall not be granted in respect of an item of income if it is reasonable to conclude, having regard for all facts and circumstances, that obtaining that benefit was one of the principal purposes of any arrangement or transaction that resulted directly or indirectly in that benefit. And then it also has this caveat, right? 29.9 says, unless it is established that granting that benefit in these circumstances would be in accordance with the object of purpose of the relevant provisions of the convention. If you look at the commentary of Article 29.9, you can see a number of examples where clearly there's transactions which make use of, for instance, saving of withholding tax on dividends or interest on, or something like that under the treaty. But in a number of those examples, the OECD says this is allowed because one of the principal purposes of the treaty is to promote investment. And in this particular case, a company, for instance, invests 1 or 2% more in a company to get the lower withholding tax, but it is still an investment made into that country, and therefore Article 29.9 is not triggered. Now that caveat or carve-out is not built into Article 25.5 or 12.5 of the UK-Irish Treaty, and it might have created some difficulty for the judges in dealing with this. Also, there's a difference in the wording, right? The 12.5 talks about to take advantage of this article, whereas 29.9 talks about getting the benefits of the treaty, and the court in the UK says, take advantage is a negative sin. It means to use or abuse, whereas that kind of tone is not in 29.9. So let's look further at what the court has decided. If we look at paragraph 168 of the decision, it says, and now the court comes to its conclusion on this case, right? Basically, the taxpayer wins because the court decides that Article 12.5 is not applicable, and says, first of all, the burden of proof in this case is on HMRC. When you have a principal purpose test in a treaty, the UK court says, it is not for the taxpayer to prove that they passed the principal purpose test. It's for HMRC to prove that they failed the principal purpose test. Now, I'm not sure that a lot of countries are going to do the same with 29.9, but this is the UK point of view on Article 12.5. SICL, that is the Cayman Island Company, is a relevant person for the purpose of Article 12.5. Now it seems as if this whole discussion of person for Article 29 is not applicable because it's written in the passive voice, as I've said. But we'll come back to this. There was an interesting discussion about this whole person thing, because you can see here in paragraph 88 of the decision, Mr. Grodinsky, which is one of the litigating parties, one of the lawyers, submitted that SICL was not a person concerned with the creation of the debt claim for which the interest was paid. In saying this, he relied on the fact that because Article 1 of the treaty stipulated that the treaty shall not apply to persons, shall only apply to persons who are residents of one or both of the contracting states, the reference in Article 12.5 to any person concerned with the creation or assignment of the debt claim in respect of which interest is paid must necessarily be confined to persons who are resident in one of the contracting states, and therefore the purposes of SICL could not be taken into account for this context. So basically what Grudzinski tried to argue here was saying, when you do the principal purpose test, you can only do that for the principal purposes of residence under Article 1, and the purpose of non-residents do not count for this test. Now you can already hear here, this is a bit of a stupid argument, right? Because in that case, no treaty shopping should ever be disallowed, because by definition, the one doing the treaty shopping, trying to buy into a treaty to which they are not entitled, will not be a resident under Article 1. So the other lawyer, Mr. Brinsmead Stockholm, also says that it is not right. First of all, it says the word person is defined in Article 3.1g of the treaty, not Article 1. That definition was not subject to any form of restriction as to residence, nationality, or citizenship, right? The language from Article 1 did not mean the word person. Article 12.5 should be limited to persons resident in the contracting state. Instead, they were simply saying that in applying Article 12.1 to BLM, SICL fall within the person category of persons whose purposes were relevant for the purposes of Article 12.5. I mean, it's a little bit of an unclear argument there. But then he comes with, as far as I'm concerned, the strongest argument. It says Mr. Grudinski's construction would undermine a large number of provisions in the treaty. For example, it would mean that the other person to which reference was made in Article 12.4, and there's a number of other articles in the treaty talking about other persons, would need to be limited persons to resident in the UK or the Republic of Ireland, which would not accord with the purpose of that provision, right? And that is, not every reference to persons in the treaty is only to one of the residents of one of the two contracting states. I mean, you simply wouldn't be able to read that the treaty that way, and that's what it also says in the next point. He says it would make Article 4 of the treaty circular and unworkable, as it would mean that any person could be a resident under Article 4 only if the treaty applied to it under Article 1, but for the treaty to apply for it under Article 1, the relevant person would need to be a resident. So, you get into the circle where Article 1 refers to Article 4, refers to Article 1, refers to Article 4, and no other person would exist, not even those abusing the treaty. So this is one of the discussions going on, and decisions from a court saying that Article 12.5 doesn't refer to persons which are residents only, so you can also have non-residents with the purpose of abuse of the treaty. Then if you look at paragraph 3, HMRC needs to show that either BLM or SICL or both had as its main purpose, or one of its main purposes, taking advantage of Article 12.1 by means of assignment of the SAD South claim. And again, Article 29 avoids this negativity of taking advantage of, right? Mother tongue speakers of English would recognize this, and actually the litigating parties refer to the Oxford English Dictionary, saying article taking advantage has a negative connotation, obtaining the benefit, on the other hand, less so. And then we come to the fourth point: the main purpose of each BLM and SICL in relation to the assignment of SAR claim are to be determined subjectively in the light of all evidence, including but not exclusively inevitable and inexorable consequences. And so there was a discussion here of what kind of purposes should be considered, and the parties, and it's not quite clear to me, this was a UK specificity, I think. One of the parties said, well, it can only be those that are unavoidable consequences. Or it shouldn't be one that is only unavoidable consequences. It can only be the subjective ones. But I don't think this has much use for Article 29. And then we come to it is not necessary for Article 12.5 to apply for there to have been artificial steps or arrangements. So one of the arguments from the taxpayers on this issue was, I believe, that since there were no additional steps added to the transaction, there could have been no artificial steps, which means that there could not have been any abuse, which means that you could apply Article 12.5. And basically the court and HMRC said there is no need for any artificial steps. I mean, you can still abuse a treaty and have a purpose of abusing a treaty, even if you add no artificial steps, right? And so 12.5 focuses on the purpose of a person. 29 focuses on arrangement of a transaction. If you look at the wording, 29 says, the purpose of the transaction is to obtain the benefit, which is very strange because an inanimate thing like a transaction cannot have a purpose, right? It's only a thinking thing that can have a purpose. But this personification in the OECD, which is very strange to put a figure of to put figures of speech into a tax treaty, doesn't matter, because actually the OECD means the same. They do refer to a person, even though the text of Article 29.9 does not say so. It's a bit of a sloppy drafting, but if we look at what the OECD commentary says about principal purpose, it says in paragraph 178, to determine whether one of the principal purposes of an arrangement or transaction, just call arrangement, is to obtain benefits under convention, it is important to undertake an objective analysis of the aims and objects of all persons involved. Now, if it is the aims and objects of all persons and not the principal purpose of the transaction, why don't you talk about the aims and objects of all persons, right? And then the OECD says, in putting that arrangement in place or being a party to it. What are the purposes of an arrangement is a question of fact which can only be answered by considering all circumstances surrounding the arrangements, but the same as the court says, on a case-by-case basis. It is not necessary to find conclusive proof of the intent of a person concerned with an arrangement, but it must be reasonable to conclude after an objective analysis of the relevant facts and circumstances that one of the principal purposes of the arrangement was to obtain the benefits of the tax convention, right? And the principal purpose, in other words, of the person behind the arrangement. Sloppy drafting from the OECD. And then they talk about an interesting point when they diverge from the UK court here, because in paragraph 181 they say, where an arrangement is entered into for the purpose of obtaining similar benefits under a number of treaties, it should not be considered that obtaining the benefits under other treaties will prevent obtaining one benefit under one treaty from being considered the principal purpose for that arrangement, which is different from what the UK court says, and we'll see that in a moment. And the issue here, for instance, is, you know, if you make an investment into a country which happens to have a tax treaty and a bilateral investment protection treaty, there was this old game among tax advisors to say, well, you know, if they say that the principal purpose for this transaction was to use the tax treaty, and you say, no, you don't understand. It was actually to make use of the investment protection treaty and vice versa, right? And what the OECD here says is those kind of arguments do not work. We don't care if it also has as a principal purpose to use other treaties, but it includes this treaty, and therefore you could fail the 29.9 test as a principal purpose test, even if you don't know which treaty it is, yes, that you are going to have that principal purpose test for, right? And if we go back to HMRC, or the UK court decision, what we see here, it says in paragraph 6, so far as the main purpose of SSL are concerned, it is insufficient for Article 12.5 to apply for SSL to have had a main purpose of taking advantage of a provision of UK domestic law or the treaty which was unknown to SICL. So SICL didn't care who it sold the principal and the forthcoming interest to, as long as it was someone that made use of some treaty somewhere with the UK reducing the withholding tax, right? So instead, for Article 12.5 to be capable of applying, SICL needed to have had a main purpose of taking advantage of Article 12.1 specifically, right? Article 29 covers a benefit under this convention, but in other words, not taking advantage, right? And the issue here was that if you go through the court decision, SICL did not know who the buyer of the loan was, because as we saw in the beginning, the loan was first purchased by Jeffries, who is this loan broker in the Cayman, who then on-sold the loan back to back basically to BLM, right? So and SICL did ask in the end. They said, you know, we're not signing the contract until we know who the buyer is, but it won't change the conditions, whoever it is. We just need to know it for regulatory purposes, etc., etc. And the mere fact, you know, that it was so clear that SICL didn't know who it sold it. It could have been to a South African company, a Dutch company, whoever, any other country that has a treaty with the UK that reduces the withholding tax to zero would have been sufficient, right? And since he didn't know it was a UK-Irish treaty, therefore it couldn't have been a transaction to abuse or take advantage of Article 12.5. And the OECD does not do this, right? We just saw that in our previous quotes for the OECD, and if we now look at what the court first said about this necessary purpose, it says, although we agree with Mr. Brinsmead Stockholm that the existence of artificial steps or arrangement is not a necessary precondition to the application of 12.5, we do not agree with his interpretation of the nature of the purpose, which is a necessary precondition to that application. It's not clear to me. He made a number of points about this. I'm not sure exactly with which point the court disagrees. But the court goes on to say, in our view, it follows inexhaustibly from the language of or used Article 12.5 that one, in order for a person to fall within the ambit of this article, it is necessary for that person to have a main purpose taking advantage of Article 12.1 specifically, right? Because 12.5 talks about this article, it doesn't talk about this treaty. And two, a person cannot have a main purpose of taking advantage of a provision of UK domestic law which is not specifically identified, and that is because SICL didn't know where the buyer, the ultimate buyer of the loan was resident until it actually basically agreed to the agreement and definitely the sales price. And if we then see what the OECD says, it says, you know, we think it's helpful to the analysis to break the question. Sorry, this is the UK court still talking about the question about the principal purpose, and it says we can break them into 4 separate questions, right? Did BLM in Ireland have as main purpose to take advantage of Article 12.1 for itself? Did BLM have as main purpose enabling SSCL to take advantage of 12.1? Or did SSCL have as main purpose to take advantage of Article 12.1 for itself? Or did SSCL have as main purpose to enable BLM to take advantage of Article 12.1? Now, these are very similar questions, but you change the subject and the beneficiary all the time, right? And the court says we've broken the question into 4 parts because each of them raises slightly different issues, and that is correct. But then the court goes on to say, more importantly, it highlights an important point, whether the last 3 questions are relevant at all. So as far as the court is concerned, BLM is a taxpayer, and the question is whether BLM had as a main purpose to take advantage of the treaty, right? And specifically Article 12.1. And then the court ends with the conclusion, in our view, these other 3 questions are not relevant. I'm not quite sure how the OECD would look at Article 29.9 if you were to break these questions down. Similarly, one more point is there's an example in Article 29.9 on the commentaries, paragraph 176, and the question is whether that would be applicable in this case, right? The example goes as follows. You've got state T, state R, state S. R has a treaty with S, but T does not. And then TCO acquires from its parents a loan plus interest from ESCO. It also acquires the shares in ESCO. And there's withholding tax on this loan, on the interest paid from S to T, and what TCO then does is it transfers the loan to ARCO, which is in a treaty country, and the question is Article 29.9 applicable? And the OECD concludes yes, it is, because it is likely that one of the principal purposes of transferring the loan from TCO to ARCO was the fact that there's no withholding tax paid from ESCO to ARCO. And something similar happens in our UK transaction, right? Because the loan and primarily the interest payments are transferred from the Caymans to Ireland, and it is to make use of a reduction of UK withholding tax under a treaty. Even though Cayman didn't care which one, right? The UK court came to the conclusion that there is no abuse because Cayman didn't know to which treaty this would be the case. We already saw the OECD writes something quite different. And also, if you look at the example under paragraph 176, the OECD comes to a different conclusion. It says the phrase that resulted directly or indirectly in that benefit is deliberately broad and is intended to include in situations where the person who claims the application of the benefits under a tax treaty may do so for a transaction that is not one that was undertaken for one of the principal purposes of obtaining the treaty, right? But when the parent of TCO initially extended a loan to ESCO, which is then transferred to TCO, that loan was there was no purpose there of obtaining a benefit of a treaty, right? That only happened when the loan was transferred to ARCO. So in the example, as I just described the facts, TCOs of state E acquired all the shares of ESCO of state S that were previously held by ESCO's parent. So it's ESCO's parent, not TCO's parent. These include a 4% loan made to ESCO payable on demand. There is no state S, state T treaty, and interest payable to ESCO would be subject to 25% withholding tax. On a state RS treaty, there is no withholding tax on interest. Looks very familiar. And then the OECD says TICO transfers the loan to ARCO of Estate R in exchange for promissory notes, whilst ARCO is claiming the benefits of the Estate R as treaty for a loan that was entered into for valid commercial reasons, initially between ESCO and its parent. If the fact shows that one of the principal purposes of TICO in transferring its loan to ARCO was for ARCO to obtain the benefits of Estate R as treaty, then Article 29.9 would deny that benefit, as that benefit would result indirectly from the transfer of the loan, right? So under OECD, this Burlington loan transfer would not have worked, and the UK would have been entitled to levy the withholding tax on the interest being transferred to Ireland instead of to Cayman. And then finally, I want to make you aware of a blog written in a Cleaver International Tax blog by Jonathan Schwartz, a barrister in the UK, on this case, and he discusses a number of points that are interesting. It's about a 2-page blog. He also ends with an interesting opening, basically, because it's a future blog. He says, while the conclusion on the facts is undoubtedly correct with sounding reason, the approach to treaty interpretation by both parties, HMRC and the taxpayer, left much to be desired. In particular, recourse to Article 3.2 to determine the meaning of the main purpose, or one of the main purposes, which was not defined in the treaty, as a basis for relying on UK tax law. Jonathan does not like this argument, right? And he says the real reason is that UK decisions, in common with those of other jurisdictions, are intrinsically sources of international law as establishing general principles of law, or are themselves sources of law, and then he refers to a statutory international court of justice. Now, I found this an interesting statement to say that international tax cases are sources of law for a number of reasons. One is under the Vienna Convention of the law of treaties. One would have to wonder whether such case law then would be primary or supplementary means of interpretation. It definitely would be supplementary at best. But secondly, there is the issue, which is also discussed in Fothergill and a number of other landmark cases on treaty interpretation, which is very clear that the law of the court of one country cannot bind the court of another country, even if it is interpreting the same treaty, right? It can be used as guidance, but it cannot be binding. So I'm interested when Jonathan is coming with his blog to see what his further explanation for this text would be. I hope you enjoyed this case. It was a good theoretical discussion on international tax law for a change, and I look forward to our next discussion with you. Bye for now.